there are some unexploded bombs. One unexploded bomb is really the bomb that brought down, as an example, First Republic and Silicon Valley Bank, which is to say that they gorged on long-dated fixed-rate obligations, which they funded in short-term deposits. When the interest rate went up, the net present value of those obligations went down at the same time that the yield relative to their cost of capital collapsed. So you have institutions as large as the Bank of America that have really pretty ugly unfunded holes in their portfolio.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 4th through November 11th, 2024, while supplies last. This week we feature the 2024 1-ounce gold UK Lion and Eagle coin, a highly limited release, available at just $99 over spot. We also have backdated silver 1-ounce Britannia at just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this returning guest, Rick Rule, formerly the CEO of Sprott Asset Management, now the CEO of Rule Investment Media, joins us this Tuesday, November 5th, 2024. Not sure if this is a day that'll live in infamy, but it certainly is a noteworthy date in the history of the U.S. But Rick, thank you for coming back on Liberty and Finance.
A pleasure, Donegan. Thank you. I enjoy these conversations. I hope your audience does too.
One of the things that comes to mind being presidential election day in the U.S. is how you have talked to us about the not helpful role that governments generally play in people's financial lives, and not just people's, but companies and et cetera, through taxation and inflation and monetary policy and fiscal policy, et cetera. So I guess I'll kick it off with that. Is there any one or two predominant thoughts that press to the front of your mind at this moment in history, either financially or with restrictions to things like natural resource development, et cetera, that you're watching closely as we go through this process?
Well, as a citizen, you know, it's probably incumbent on me to go beyond natural resources. Too often, what politics is about is asserting your interest against your neighbor's interest through the political process. So to the extent that the political process favored natural resources, and to the extent that I participated in that, I would rightly be regarded as a thief, which is something I would prefer not to be. I would just ask people to consider whether they are more interested in being protected by their government or protected from their government. I am sort of part of the latter camp. I suspect politically myself, I'm part of a very rare breed that subscribes to something called the non-aggression principle, which is to say that I don't believe that I have the right to negotiate using violence or the threat of violence. I can employ violence in the defense of my person and property, but I can't use violence to impose my will on others. And I would argue that the state, stripped to its essence, is an entity that reserves unto itself the right to violence, extortion, and fraud. I certainly understand that it was partly set up as a medium to, as an example, adjudicate disputes, but I would suggest that it's gone very, very, very much further, and frankly, in not very good ways. So I would just ask people whether or not they feel comfortable aggressing against their neighbors through government, and again, whether they would prefer to be protected by government or from government. I realize there's a spectrum of opinion, and I'm delighted to be part of several forums, this included, where disputes like this are usually conducted in polite fashion. So unlike other political forums that I've been reading for the last 2 months.
To augment one of the parts that you mentioned there about fraud, I know you've talked to us about that in the past, about, for example, fiat currency creation out of nothing being theft, and and that if I printed Dunnigans in the basement, I would be locked up for counterfeiting. But if the Fed does it, then in collusion with the Treasury, that's just fine, and it steals everybody's savings and earnings and retirement. One of the things that you reminded me of just now is a quote I just saw this week from Margaret Thatcher, former Prime Minister of England, saying, or the UK, saying that the government, it's a complete misunderstanding that people have that the government has money. She says the government has no money. All they have the ability to do is to take it from you and to use it for other things, and they can borrow it from you if they're borrowing it from the future, or they can just take it directly from you. But either way, don't ask for the government to spend money on things if you're not willing to have them take it from you, because that's exactly what they're going to do in order to do that. I know you've been pretty outspoken about that in the past, and it's certainly something that is near and dear to the hearts of our viewers and subscribers, because most of them are late career stage or retirement age, and they're very concerned about trying to make it through with what they have, their nest egg and their ability to steward that wisely. But they feel that they're swimming upstream against the powers that be, which even their own government as an adversary in their financial freedom. Any specific comments you have from that about that at this time, in the time that we're in right now?
I would ask them to extend their fears beyond themselves, the primary fear, and be afraid too for their children and their grandchildren. When I look, and I'm not going to describe the entirety of government, that would take longer than we have. But when I look simply at the debt and deficits, when I look at almost $36 trillion in on-balance sheet obligations against a $6 trillion Fed balance sheet, or more importantly, I think, when I look at the net present value of unfunded entitlements and off-balance sheet liabilities, which exceeds $100 trillion, I'm struck over the fact that in farmers' parlance, as a society, we've eaten our seed corn. I saw an interesting statistic the other day, published by the IRS, where they estimated that the net private wealth in the public's hands, not in the government hands, in the United States, was about $140 trillion. That's an interesting number, because the on-balance sheet obligations of the U.S. government exceed $35 trillion, and the off-balance sheet obligations, net present value, exceeds $100 trillion, which is to say that we are in debt for almost the entire net worth, private net worth in the United States. I realize those obligations come due over time, and I realize that there is cash flow with which the government proposes to service that debt. I would only suggest to people who find solace in that on a current account basis, rather than servicing the $35 trillion in on-balance sheet obligations, we're adding to it to the extent of almost $2 trillion a year. So in terms of your listeners who are afraid for themselves, yes, be afraid for yourself. But be more afraid, I think, for your children and your grandchildren. Then again, your generation, and more mine, because I'm a bit older than you, voted ourselves all these cool benefits, but we forgot to pay for them. The bill likely comes due in crashing form when I'm senile or dead. But the bill will come true. In terms of the current generation, what they need to fear is that politically the way out of our debt crisis, in particular the net present value of entitlements, will be to honor them in a nominal sense, but not in a real sense. According to the IRS, in the decade of the 1970s, through inflation, the U.S. dollar in 10 years lost 75% of its purchasing power. If you believe, as I do, that the way that we handle the unfunded net present value of entitlements will be to inflate them away, what I think is that some old geezer named Rick Rule, who has been promised some amount of Social Security, I don't know what it is, $4,000 a month, something like that, I'll still get my $4,000 a month, but it'll buy what $300 or $400 a month does now. If you look back at the decade of the 70s, I would suggest that that's what you're going to see in the 10 years that come ahead. Now, people will point out right away, but Rick, Social Security is indexed to inflation. First of all, it's indexed to the CPI, which isn't an accurate measure of inflation. And secondly, as they come to realize that it's unfunded, Social Security will become a real transfer program, not an insurance program, which is to say that the index might go away. They installed it so they can uninstall it. Certainly, I suspect that they will means test it, which is to say, if you are somebody who has achieved and earned in society, your reward for having paid into Social Security for a very long time is that you won't get it. In addition to that, likely, they're going to have to change the age requirement. When Social Security was instituted, it provided basically poverty-level existence beginning at age 65, and the average life expectancy of an American male was 66 years. Now you can begin claiming it at age 62, unless you suffered a disability, in which case it's earlier, and the average life expectancy, as I understand it, of an American male is 83 years. That's a very, very different actuarial assumption. In addition to that, of course, our population is aging. So when you talk about the fact that your listener base is concerned about the state of the economy, to the extent that your listener base hasn't made adequate provision for themselves and is in fact counting on Medicare, Medicaid, Social Security, a plethora of projects that indeed they paid for 40 years, please understand that their payments weren't sufficient, first of all. Second of all, that the money was taken. It's already been spent. And third, that while they will get the nominal benefit that they have been promised, my suspicion is that the nominal benefit will be tempered by inflation, which is to say, in terms of the maintenance of the purchasing power, those nominal benefits will buy them 75% less 10 years from now. And I think it's a very important realization for people.
Let's expand on that point you just made about nominal benefits of Social Security not providing the lifestyle that you imagined they would, or that you hoped that they would, because it doesn't just, this same principle does not just apply to Social Security. It applies to people's nest eggs that are stored in cash equivalent accounts or money market savings accounts or bonds or whatever. It applies to pension funds that have made certain investment decisions or assumptions based on the performance of markets over the past 40 years, et cetera. So how widespread do you believe that rude awakening is going to be for not only for individual retirees, but also for managers of insurance companies and endowment funds and all kinds of other things who realize that the assumptions that they've based their success on for the past 40 years are completely unfitted to the future that lies ahead, the reality that we're facing?
Let me be clear, Donegan, we're going to get through this, just like we got through the decade of the 70s. I remember very well at the beginning of the decade of the 70s talking to my grandfather about the uncertain future that I faced. I remember, as an example, looking for colleges to attend in California and basically having to wear a gas mask in 69 or 70. You know, social turmoil, racial turmoil, the economic turmoil that I've described. And I remember my grandfather saying, you know, son, my generation faced some problems too. We had World War I. And then we had the Great Depression. And then we had World War II. Don't go in the corner, crawl up, and assume the fetal position. Understand you got some challenges. Understand the person to deal with those challenges is you, and work your ass through it. And I think it's important that people not use the outlook as an excuse to fail, as an excuse not to work. Yes, if you have a defined benefit pension plan, it is very likely that the benefits that you receive, while you will receive the nominal sum that you were promised, maybe not, but more likely than not, yes, will buy you substantially less. And if your retirement planning assumes that the nominal value of the benefit that you're receiving buys you the same basket of goods and services that you enjoy today, you need to alter your plans. You need to save more. You need to spend less. You need to understand that if you are going on a fixed income, assuming that the nominal value and the real value of your income will be the same 10 years from now, unfortunately, you're in for a real shock. And I think that your listeners need to consider that. It would be lovely if I were wrong, Dunnigan. And assuming I'm wrong, what happened? Somebody had more savings. They had less stress. Being wrong would be a wonderful thing. I don't think I am, of course. I think I'm right. And as I say, don't use this as an excuse to panic. Don't use this as an excuse to fail. Use this as an excuse to plan and think through your future, your family's future, your kids and your grandchildren's future. That's what this call to action is about. I'm not trying to generate, a whole bunch of clickbait headlines. I'm just asking people to consider the arithmetic probability that as a society, we can honor our debts without inflating away their net present value. I would suspect that the odds of that are nil, zero.
In part of this call to action, for people to realize, wait a minute, the plans you thought you had laid are not going to be sufficient. You got to pivot. You've got to shore them up. You got to do different, and you have to spend different and invest differently. You mentioned earlier that dollar-denominated, the currency is being sacrificed in front of our eyes. It's being done at a pace that most people just grumble about, but they don't look at the big picture of realizing, wow, this is going to wipe out this part of my plan and that part of my plan and so on. One remedy for that we've discussed in the past is having tangible assets that hold their value rather than losing their value with the destruction of the currency. The natural question that I get asked by viewers, and they ask me every week on this, is how much is enough? Because their retail financial planner didn't tell them any. So zero was what the financial planner said was, you don't need any tangible assets. Just put 40-60 stocks and bonds and you're good, or 60-40. Now if they're hearing, gee, that's not going to cut it for me. I'm going to need to have some tangible assets to hold value through this and perhaps even gain. And we'll talk about why mining companies may be an amplified way of enjoying those gains, et cetera. But how do people approach that question of how much is enough of tangible assets in their portfolio once they realize they can't keep listening to their advisor who's been telling them zero or not telling them anything?
Dunnigan, there isn't a one-size-fits-all answer, unfortunately. A person who has been prudent in his or her life and bought 2 or 3 or 4 pieces of modestly leveraged rental real estate has an inflation hedge. If their rents are sufficient to service the mortgage, and if their rents are fair in the context of the market that they operate in, inflation will raise the price of the construction of competing assets at the same time that competitors' cost of capital will go up. So people who have structured inflation hedges into their life, their own business where they have some pricing power, some moderately leveraged but high quality real estate, need to own less. As an example, physical precious metals. I will say too that too many people who buy our narrative overinvest in precious metals. They invest so much of their net worth in precious metals that they can't stand the periodic price declines that occur in precious metals. I remember very well in the decade of the 70s, in the period I'm guessing 1970 to 1974, early 1975, the gold price had advanced from an admittedly price-controlled $35 an ounce up to $200 an ounce. And of course, all the gold bugs were geniuses, you know. Then the Fed raised the interest rate, and the gold price fell by half. The gold price fell from $200 to $100. It was a 9-month wipeout. And all those brave gold bugs, not all, but most, or at least many, turned tail and ran. What happened was when the price action didn't justify the narrative in the short term, people's faith vanished. And there were wholesale liquidations of gold. The people who did liquidate, the people who didn't have the financial or psychological wherewithal to stay the trade, missed a move in the gold price from $100 an ounce to $850 an ounce. The point is that your holdings of precious metals or precious metals equities need to reflect A, your needs, but B, your psychological and financial stamina. If you are over-invested in the space, you are likely to get shaken out. The second thing that people need to understand in terms of position sizing around precious metals is that if you own them for insurance, a little bit goes a long way. If you look back to the decade of the 70s, forget about $35 an ounce to $850 an ounce. Let's assume that the move from $35 an ounce to $100 an ounce was recovery of ground that was lost during the period where the gold price was controlled. So let's just say at the beginning of the period that the free market price of gold should have been 100, and it went to 850. That's an 8-fold move in the gold price. Fast forward to the decade 2000 to 2010. The gold price moved from $253 an ounce to $1,750. What's that, a 7-fold gain? I'm not suggesting that gold is going to move 7-fold or 8-fold in the next 10 years. All I'm suggesting is that gold historically has had really substantial upside, much better upside than people who don't read history have any sense of. You know, when people today are excited about the fact that gold's 2,700, and I've said this on your show, I don't own gold because I think it might go from 2,700 to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000 or some higher number. I don't know what a 7-fold increase from $2,700. I don't know what that number is. And I'm not saying it's going to go there, but I'm not saying it's not either. Again, it seems to me the only way out of our fiscal and political impasse is to reduce the net present value of the promises that we've made to each other. The time-honored way to do that is inflation. The IRS, not some cranky old libertarian, suggested in the decade of the 70s the U.S. dollar lost 75% of its purchasing power. If that were to occur in the next 10 years, it's anybody's guess where the gold price might go. People also need to understand I might be wrong. You don't want to have a larger investment in precious metals than corresponds with your financial and psychological ability to take risk. A little bit goes a long way, but get that little bit. Get that little bit. Do you realize, Dunnigan, as a society, I'm talking about the United States right now. In the United States, precious metals and precious metals-related assets comprise 0.5% of total savings and investment assets nationwide. That paltry number is down from a 4-decade mean of 2%. If we're looking at a circumstance where it is more likely than not that you inflate away the net present value of $135 trillion in obligations, it's not unreasonable to assume that the dollar will lose 75% of its purchasing power, like it did in the decade of the 1970s. I'll leave it to anybody's guess what impact that might have on the gold price.
Before I get to the next question, I wanted to follow up in the same train of thought. I want to take a little sidestep because you just mentioned government actions as part of this equation. the primary government action, and not just government, but central banking action you're talking about, is destroying the currency to destroy the obligations. Get yourself out of obligations that you've made by saying, sure, I'll pay you back in funny money. Just let me go print some more in my basement. Hold on. Along that pathway, the government has made, lots of commitments to people, but even the current candidates for president, and by the time this is aired, we may know more about which one is going to prevail here, have said things like, make groceries affordable again. You can guess which one said that. Or the other said, we're going to help first-time home buyers by kicking in $25,000 to help each of them, and we'll talk about their student debt going away, or that sort of thing. So it seems that all of the remedies that are being proposed make no sense, not even rationally coherent together with what you're saying about the underlying direction that must be, and seems to continue to be, destroying the currency in order to destroy the obligations. If we're going to destroy the currency, that groceries are not going to look affordable again, and throwing $25,000 checks at everybody who wants to buy a first house is not going to make the price of houses go down, et cetera. Your view of these political narratives that are being proposed as solutions to the unaffordability.
This will get us a lot of hate, Dunnigan, which will show we did a good job. H.L. Mencken, I think it was, described elections as advanced auctions of stolen property, irrespective of the party in power. I've been on Earth for 71 years, and I have yet to experience a presidential administration that reduced government spending. Reagan reduced the growth of government spending, but he didn't reduce government spending. Another wonderful quote that I'd love your viewers to remember is this: politics, the activity, is understood by examining the root words. Poly, of course, from the Greek for many, but tick is from the English colloquial for small, blood-sucking insects. If you think about the political process as being many small, blood-sucking insects, each trying to suck the lifeblood out of the other, you understand the nature of politics. I've received a lot of inbound email, and don't think of this as an anti-Trump rant. I don't like either candidate. But a whole bunch of people say, well, the problem that you describe is past tense, because Trump is going to bring on Elon Musk and Ron Paul, and they're going to reduce the size of government by 80%. I remember the same discussion around Reagan. For people who believe that fiction, I would ask them to buy a book called The Triumph of Politics by Dave Stockman. He ran the Office of Management and Budget in the in the Reagan administration. And he talks about the fact that the planned reduction in the size of government that was the promise in the first Reagan term lasted through 90 days of politics. So, as I say, I would ask people to read the book, The Triumph of Politics by Stockman. I'm not suggesting to you that Ms. Harris is a better candidate than Mr. Trump. I'm suggesting to you that if you hold out hope that Trump will reduce the size of government, and if you are using that as an excuse not to be concerned personally about $135 trillion of collective obligations, that you're making a mistake. Rely on yourself, not on Harris, not on Trump.
Along that path of trying to become more self-reliant, people have been calling me on a weekly basis and asking, well, you had asked me before we even got started, how's the bullion business going? And I talked about the slow summer that seemed surprising to me, because in the face of this runaway debt and deficit, that's when we learned that we're putting another $1 trillion in our debt every 100 days after 200 years to rack up the first $1 trillion in debt, et cetera. That it's almost as though people have become numb to this and think that that's the new normal. And how can that be any semblance of normal, rather than people who are aware of the danger of this to their future and their children's and their grandchildren's scrambling into real assets. But a lot of people, as I also shared with you, were awaiting a dramatic pullback, not only in the broader equity markets, et cetera, but also in metals, so that they could finally load up on back up the truck and and get there. As you said, get your bit, whatever your bit is of that. And gold seems to have been just stubbornly holding its own through this year, and that pullback that people have been waiting for doesn't seem to have materialized. Thoughts from you on, well, other than we have to both agree that in the face of destruction of the currency, even something that seems to be treading water is actually falling behind as well in terms of purchasing power if it's not advancing with the rate that the currency is being destroyed. But beyond that, what are you anticipating? Are you also looking as a contrarian investor for a dramatic pullback moment to make a big increase in your positions of real things? Or are you just looking step by step, opportunistically looking along for special situations where you see them and finding value where it can be found?
Dunnigan, I've been systematically buying physical gold since 1999. I don't need to buy more gold. I'm going to buy more gold, but the fact is I own lots relative to what I might need. Other people are less fortunate. Most of the American public, if pressed, probably couldn't spell gold. And I think they need to begin the process of systematic acquisition of gold, unless they have some other internal inflation hedge that works for them. In fact, with regards to my own circumstance, a good financial planner would look at my estate, being the largest shareholder of Sprott, and say, why do you own gold at all? If the gold price does well, the businesses that you own will prosper, and you'll win by proxy. I own gold because it's insurance. It helps me sleep nights and stay calm. Sleep is a good attribute if you're 71 years of age. So everybody's circumstance is different. For people who have their lives structured in a way that persistent inflation will be ugly for them, people with long bond portfolios, people relying on conventional pensions, particularly defined benefit pensions, I think they need to begin the process of the systematic acquisition of assets that are traditional inflation hedges, and they need to do it now. If the price of those assets falls, God bless. If I'm wrong, then your conventional pension will do a good job for you. But I would ask those people to consider the probabilities of what I've said and judge their actions accordingly. I have found myself, if you look at the whole of my net worth, the whole of my portfolio, I found myself adding cash. It is not a deliberate strategy. I'm not trying to get liquid. I am already too liquid. What's happening is that some of my speculative bets and some of my investments have paid off. They've gotten to the point where they're no longer cheap, so I sell them, and I haven't been able to redeploy the money. It was interesting. I'm not trying to liken myself to Warren Buffett, but I listened to Buffett's discussion the other day about the cash holdings of Berkshire Hathaway exceeding $300 billion. And what he said is, I'm finding myself opportunity constrained. He isn't suggesting that the market's going to collapse. He is suggesting that when he looks to buy businesses in the size and of the quality that attracts him, that there aren't very many opportunities. At the same time, some of the existing businesses that he owned in a large measure, Apple as an example, Bank of America as an example, are at this price, relative to the earnings stream he sees them generating over the next 5 to 10 years, less attractive. He hasn't been a seller from a strategic point of view. He's been a seller from a tactical point of view. And I find myself in the same circumstance, albeit, sadly, with a couple zeros missing.
Yeah, I noticed that article about Berkshire Hathaway carrying a lot greater cash balance than they have in the past as well. And it's interesting. So one nuance of that I wanted to ask you about is when people are looking at acquiring physical, for example, precious metals or other intrinsically valuable physical assets versus mining companies or royalty or streaming companies or other companies that that stand to benefit richly if the metals do well, that sort of thing, or if there's a rush into real assets. How do you see us for the longest time? It seems like to me over a couple of years now, the equity shares in the natural resource industry were lagging far behind and didn't seem to be showing as much life. But now that's changed. Can you give us your view of where we're at in that process and if there's still values to be found there?
I will. I suggest that in every precious metals bull market of my life, the bull market has been led by the metal, gold specifically. And I suspect that for most investors, that is the way that they should organize their lives. The purchase of physical gold is really the purchase of insurance. And it's important that people buy insurance before they even invest. It's important that to the extent that it's possible, that you have an asset that will help your family sustain its lifestyle in bad circumstances, and that's physical gold. In a normal bull market, after the gold price has moved, to the extent that it's moved enough that producing companies generate increased profits, because remember, when the gold price moves, often the price of inputs around mining it increase too. So that the margin increase that you would expect to see often doesn't occur for 3 or 4 quarters. And that's precisely what we've seen. But this year has seen a real lift in the prices of ultra-high quality gold stocks. Agnico Eagle almost up 50%, Wheaton Precious up 45%. Even Franco-Nevada, the highest quality of all gold companies, despite the fact that they lost 15% of their asset base with the nationalization of Cobre Panama, is up substantially. If past is prologue, the momentum that we've seen established both in the metal and in the senior gold shares will begin to embolden investors, and they'll look at valuation discrepancies between the biggest and the best and the second tier, and they will move down market. If they don't move down market, the great big companies will enjoy higher share prices and lower cost of capital, and they'll take over the second-tier companies. And after the second-tier companies, the market will go to a riskier asset class, which is to say the single-asset producers. And again, some investors will look at valuation discrepancies. Others will look at potential M&A, and that sector will benefit, and so on, and so on, and so on. Finally, assuming that the market has legs, and I think this one does, that move will come down to the penny dreadfuls. And when you see the nothing, no account penny dreadfuls, the ones with $10 million market caps but no net present value, double and triple, it's time to begin to look for an asset class that's more out of favor. You need to remember that we reach certain periods of time where even in a good sector, even if you are a practiced investor or speculator, there's not much value left in the sector. That's what Warren Buffett is saying about the New York Stock Exchange. So it's important that people understand that. I believe that there is substantial value left in the gold equity sector. I believe, though, that for investors who aren't willing to do the work, naked commercial, for people who aren't willing to sit through the Rule classroom, as an example, that people confine their investment in gold miners to the very, very, very highest quality companies. What you learn is in a real gold bull market, simple market beta, which I would define as the outperformance of the sector relative to the broad market, is so substantial that you'll get doubles or triples, taking almost no operating and company risk. Now, if you're comparing that with a 10-bagger, which you might get with taking a lot of risk, that appears unattractive. But if you look at it in isolation, the idea of a low-risk double or triple over 5 years with handsome dividends while you wait, and by the way, with the probability of that outcome, as opposed to the possibility of a tenfold move in a lower quality company, for most people who aren't willing to do the work and can't afford psychologically or financially to take risk, they should, at least in this point in time in the market, confine their investments to the very, very, very highest quality gold equities.
You mentioned along the way banks, and we wanted to ask your temperature reading of the health of the banking system right now, systemically, because we have seen the second, third, and fourth largest bank failures in the history of our country last year. We've seen a small regional bank in Oklahoma go belly up about a month ago, which is somewhat ironic because that was the congressman from Oklahoma who was grilling Janet Yellen about what are you going to do in my community banks go belly up? Are you going to bail them out, their depositors out too? And she said, nah, not if they're not systemically at risk. But what your view is, since you're wearing, and we're going to get to your Battle Bank shirt there in a minute, but before you get there, what your read is of the health of the banking system in general right now.
The banking business, nominally, is very, very well capitalized as opposed to 2008. The Fed, I think, had a sober moment post-2008. And the capital requirements for the banks are really pretty high. The FDIC, too, who I've been in front of for 2 years and 6 months, has been pretty rigorous in going over at least the nominal balance sheets of banks nationwide. The reason why our bank has been 2 years and 6 months in permitting has mostly to do with the fact that the FDIC is charged with policing troubled banks. And sadly, there's a lot of them. Every time a bank gets into trouble, our application gets deeper in the pile as opposed to moves up. And I need to say, 2.5 years of dealing with low-level people in the FDIC leaves me with a grudging admiration for those people. In answer to the question, there are some unexploded bombs. One unexploded bomb is really the bomb that brought down, as an example, First Republic and Silicon Valley Bank, which is to say that they gorged on long-dated fixed-rate obligations, which they funded in short-term deposits. When the interest rate went up, the net present value of those obligations went down at the same time that the yield relative to their cost of capital collapsed. So you have institutions as large as the Bank of America that have really pretty ugly unfunded holes in their portfolio. Interestingly, the federal government, in their wisdom, allows banks, large and small, who have loans or bonds on their book to mark them as either held for sale or held to maturity. If those obligations are held to maturity, the banks are allowed to carry them on their books at par rather than at fair market value. One could argue that classically this is fraud, but it's not fraud, I guess, if it's specifically allowed by federal charter. I think the other problem that I see out there, and I'll do this before I get to the good news, the other problem that I see is that I still don't believe the other shoe has dropped with regards to commercial real estate, particularly office space, but also some forms of other commercial real estate. I see all the time now anecdotal reports of buildings that sold in 2020 for $300 million, including $225 million in mortgage financing, changing hands for $50 or $60 million. It isn't just the equity holder that gets hurt in that transaction. If the lender has $225 million in first and second mortgage obligations, and the building changes hands for 50, that means that the lending institutions are out $175 million. And I think there's a lot of rot like that in the banking system. The good news is there's a lot of good banks too. most of them fairly small. Most of them community banks in the truest sense of the word, where you have a board of directors who are part of the community, know the borrowers, know the depositors, where you have a management team that understands that you don't lend long and borrow short. You don't get caught in a duration spread or a rate spread, who understand, as certainly I've learned over 50 years, that the value of your assets is ephemeral, while the value of your obligations is always money good. Which is to say, people that underwrite loans intelligently. I'm a shareholder of several small banks. This is not a recommendation, by the way. But if you look at banks like Farmers and Merchants Bank of Long Beach as an example, or First National Bank of Hemet, what you find is what are in effect truly superb bond portfolios. When I say bond portfolios, collections of loans or mortgages, privately negotiated bonds that aren't underwritten by Wall Street, you find invariably the banks, high-quality banks like that, have Tier 1 capital of between 15 and 22%. By the way, the FDIC considers 7% to be well-capitalized. What you find is that prudent private sector people seem to prefer 20 to 7 in terms of capital adequacy. So to the extent that individual citizens want to take control of their financial future, all they need to do is go to their bank and ask for something called the Statement of Financial Condition, which the bank must provide them. Look at how much Tier 1 capital the bank has. Ask the banker how much of their portfolio is marked held to maturity and what their maturities are. If you have a bank with 7 years of maturity that's being funded by deposits that are overnight demand deposits, you have a potential problem. Ask, too, the historic relationship between provision for loan losses and actual loan losses. What you find is that a high-quality bank over-provisions. They do that both out of prudence, and they do it, frankly, as a tax shelter. The money that they put into a provision is money that comes out of current income, which means that you are establishing a loss reserve rather than paying tax. The very good companies actually underreport earnings by establishing these reserves. I have seen banks and insurance companies that have decade-long records of having 6 times the reserves that they have experience, which is to say they're actually managing their earnings down in return for lowering their tax bill and operating more prudently. It's not difficult to find these things out, but sadly, most depositors and most bank shareholders don't do that kind of work.
Now let's get to your Battle Bank shirt. You've been telling our viewers for quite some time about the approaching viability of your new bank that you're a co-founder of. And I understand we had a major change of strategy based on the underwriting or the government review process and all that you just described for us. So what's the current outlook and what can people look forward to?
What we decided to do, which frankly we should have done 2 years ago, is rather than continue the process with an overworked and beleaguered FDIC of chartering a de novo bank, a new bank, we have entered into a letter of intent to buy a very small existing bank, which has a national charter. The seller of this bank is a multi-bank holding company. We will buy the bank and then sell the existing loan book to the parent. So we aren't acquiring any assets that we don't understand. We are just merely buying a charter. This is about a $50 million bank. It's a very, very, very small bank. This will allow us to go back to the original regulator, the Office of the Comptroller of Currency, and the Fed that has to approve all of these transfers, both of whom we've had good historic relationships with, But importantly, we get out of the FDIC process because the FDIC national charter is already owned by this bank. In retrospect, this is something that we should have done 2 years ago. It's expensive, which is why we didn't do it. And our previous experience with the FDIC came at a period in time when the FDIC wasn't experiencing as much operational stress as they are today. The consequence of that is that we have decided to pay up for this little bank and amend their charter with our own operation so that we can get started much more rapidly. You know, Donegan, when we started Everbank, which you'll be familiar with, but many of your listeners won't, we had zero customer backlog. When we opened the bank, there was nobody who had expressed any interest in doing business with us except for close friends and business associates. Almost 16,000 people now have said that they want to do business with Battle Bank as borrowers against precious metals, as depositors in high-yield money market accounts, or depositors in foreign currency insured accounts. It has been gratifying to see almost 16,000 people nationwide, in fact, worldwide, express an interest in doing business with Battle Bank. We believe now, with the acquisition of a bank charter and with the regulatory process simplified in terms of simply a new business plan, which, by the way, will be funded with equity in escrow. We really look forward to getting started. For those of your listeners who aren't familiar with our prior effort, beginning in 1998, if my memory serves me correctly, we formed one of the nation's first online banks called Everbank. I'm delighted to say that the original strategy session occurred on my living room floor. And we were able, over 14 years, to attract 275,000 plus or minus depositors. And we grew the institution to $28 billion in deposits. At that point in time, we sold the bank to TIAA-CREF, who have, by the way, done a great job for their members. The difficulty came in the fact that their members, and there's 1.5 million of them, have different banking needs than the clients that we had served at Everbank. The annuity needs of retired teachers are different than the banking needs of, if you will, the aspiring class of entrepreneurs nationwide. And so what happened was, beginning at the time we sold the bank, which if my memory serves me well was 2014, the 275,000 people that we attracted to Everbank found that their bank deserted them. And we're back to serve them. And I'm just absolutely delighted that we can do this.
How do people get on your list of interested parties?
There are two ways to do that. You can go to battlebank.com directly, or you can go to ruleinvestmentmedia.com. Many of your long-term listeners will be familiar with Rule Investment Media. If you go to Rule Investment Media, provided that you like what I have to say about natural resource investing, you are invited to list your natural resource stocks at that website, and I will, for free, with no obligation, rank them 1 to 10, 1 being best, 10 being worst. In the question and comment section at Rule Investment Media, simply write bank, and I'll put you on the list. Why would you want to be on the list? Well, first of all, we don't have 15 or 20 different deposit products, many of which don't pay interest. We have one, a high-yield money market account. If you want to write checks, that's great. If you don't, that's okay too. Either way, we pay you interest, competitive interest. The second is that Battle Bank, we believe that your IRA is your IRA, not just a receptacle for products from annuity issuers or mutual funds. That means that with a Battle Bank IRA, that your IRA can own an LLC and you can buy a duplex or a triplex. And by the way, we'd love to finance it for you. You can buy a franchise. You can invest in crypto if that's what you want to do. You can invest in private equity if that's what you want to do. I didn't even realize this was legal when we were forming Battle Bank, and I was scared to death of this product until the bank's lawyers sat down with my lawyers and said, no, this is all possible. I can't imagine a product that will appeal more to aspiring investors and individuals like your audience than the fact that their IRA becomes their IRA, not a receptacle for Wall Street product. And then finally, on the lending side, it's weird that no bank in the United States believes that physical precious metals are good collateral, but I do. By the way, this doesn't cover physical precious metal that you buried in your backyard. For gold, silver, or platinum and palladium that's held in segregated accounts at any of Brinks, Loomis, or Viamat, we will provide what is in effect a margin loan or a letter of credit so that you have access to the capital that you have tied up in your physical precious metals without having to sell your physical precious metals. I'm really excited about this product. The precious metals community is a community that I've dealt with for 50 years. I know these people because I am one. And I know that from time to time, somebody who has a bunch of capital tied up in physical precious metals has a need for that capital. Down payment on a duplex, a summer home, something like that. They don't want to sell the precious metals, particularly if, like me, they've been buying it for 25 years and their basis is way low. We would like to provide access to credit for those people. And I've already been told by depositors that the idea that their deposits are being lent against physical precious metals makes them feel much more comfortable as depositors rather than having the money lent to some, leveraged buyout firm or hedge fund or something like that. What we're really trying to do, Dunnigan, is what we did at Everbank. We're trying to create a community, an aspiring community, a libertarian-oriented community, a community bank where the community isn't defined by geography, but rather where community is described or identified by values.
It sounds quite intriguing. I know our audience has been responsive already. You've already got a number of responses from us. I imagine you're going to get more at this time. And just wanting to look ahead too, are there any events upcoming with Rural Investment Media you want to make sure that our audience is aware of at this time?
We have another upcoming boot camp. Many of your audience attended our last boot camp, the Tier 1 boot camp. For those members of the audience who don't know what the boot camps are, they are very detailed, 8-hour online mini symposiums. We cover one topic at a time. We've done silver. We've done royalty and streaming. We did Tier 1 deposits. We've done uranium. We've done a variety of these things. Understand, first of all, that this is not an entertainment product. If you aren't prepared to subject yourself to 8 very hard hours, don't come. In fact, if you aren't prepared to devote 24 hours, meaning playing the recordings of that 8-hour session 3 times, don't come. This is for people who are serious about becoming natural resource investors and who are willing to do the work and spend the time. The cost for this is $99. We have an absolute gold-plated money-back guarantee. If for any reason you don't think you got your $99 worth, just email me and I'll give you your $99 back. Dunnigan, as you know, we've been offering money-back guarantees on all of our investor education products for 28 years, including our physical symposium. And I'm delighted to say that we've had to refund substantially less than 0.1% of the tuition fees that we've charged. That notwithstanding, absolute money-back guarantee. The upcoming boot camp, and I forget the date, but it's in January, is in response to customer demand. We asked people what they wanted us to cover in detail, and this time they said gold. We haven't decided exactly what aspect of gold that we're going to cover. That'll be announced, I think, in the next 10 days. But we think it's probably intelligent, given the fact that gold as an asset class accounts for less than 0.5% of total savings and investment assets in the United States, that we give people a real deep dive into gold ownership and gold stock ownership. Again, if you are looking for an entertainment product, this is not it.
So Gold Investing Bootcamp, January 25, link to be upcoming. If we get one in time, we'll put it in the description of this video. Otherwise, we'll make sure we do in the next interview. And at any rate, if people want to go to ruralalinvestmentmedia.com, they can get their portfolios ranked and find out about Battle Bank by putting bank in the comment section. Rick, thanks for re-upping those offers, and thank you for joining us again here on Liberty and Finance.
Always a pleasure, Dunnigan. Thank you for our wonderful conversations over the years, and thank you in particular for your appearance and your family's appearance at our physical symposium in Boca Raton. It was a delight to see you there.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for November 4th through November 11th, 2024, while supplies last. This week we feature the 2024 1-ounce gold UK Lion and Eagle coin, a highly limited release, available at just $99 over spot. We also have backdated silver 1-ounce Britannia at just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.